Hi everyone, welcome to episode 8 of the Talking Money with Nosy podcast. Today we are diving into the world of the stock market. If you're new to this, don't worry, I am here to break it down into bite-sized pieces just for you. I'm your host Nosy. Let's get started with Stock Market 101. Please remember that the information shared here is for educational and entertainment purposes only. This podcast should not be considered financial advice. Please consult with a certified financial planner before making any major financial decisions. Now back to our topic. So what exactly is the stock market or stock exchange? Well, think of it like a giant marketplace, but instead of buying fruits or vegetables, you are buying and selling shares of companies. So a stock exchange is a marketplace where stocks are bought or sold. There are about 60 major stock markets in the world. Of these, the most famous and largest stock market is the New York Stock Exchange, or the NYSE for short. The largest stock market in South Africa and in Africa is the Johannesburg Stock Exchange, or the JSE for short. Next, what is a stock or a share or equity? A stock or a share or equity is a piece of ownership in a company. When you buy a stock, you are buying a tiny piece of that company. Think of it this way. Let's say you went to the bakery and wanted to buy a delicious chocolate cake, but the price of the full cake is 1,000 Rand and you can't afford it. The baker then cuts the cake into 100 slices and sells each slice for 10 Rand. Suddenly, this deal is more affordable and you decide to buy 5 slices of cake. So basically, a share or a stock is a tiny slice of the bigger business. How does investing in shares make money? Investing in shares makes money in 2 ways. The first way is called capital growth. This is when the value of the shares that you buy increases over time and you can sell your shares for more than what you paid for them. For example, let's say you buy shares of company X, which currently costs 70 Rand per share. And let's say you hold those shares for 7 years and they grow in value from 70 Rand per share to 140 Rand per share, essentially doubling your investment. That growth in value is called capital growth, and you can sell those shares and enjoy your profits. The second way that investing makes money is through dividend payments. Dividends are payments made by some companies to their shareholders. It's like a little reward for owning their shares. Not all companies pay dividends, but for those that do, it's a nice bonus. Now, let's talk about how you, as a beginner, can start investing. First things first, you will need to open a brokerage account. A brokerage account is like a bank account, but instead of holding cash, a brokerage account holds your stocks, your bonds, and other investments. You can open a brokerage account with an online broker. Some popular brokerage companies in South Africa include Easy Equities, Absa Stockbrokers, Standard Bank Online Share Trading, Sasfin Securities, PSG Securities, just to mention a few. These platforms make it easy to buy and sell stocks or shares from your computer or your smartphone. When choosing a brokerage account, it is important to think about things like monthly fees, transaction fees, ease of use, and the variety of investment options available. Some brokerage platforms might offer more local stocks, while other platforms provide access to both local and international markets. Once you've opened your brokerage account, it's time to do some research. Before you start investing, you need to learn as much as possible about the companies that you are interested in. Start with companies that you know and understand. Ask yourself if you know how that company makes money. What products or services do they sell? Also, look at companies that have been around for a long time. Usually, a sign that a company is doing something right is that they have been around for long, right? Otherwise, they wouldn't survive for that long. Also, choose profitable companies with solid earnings, because that is the secret to long-term investing success. Companies which consistently increase their earnings attract many investors, which leads to higher demand for their shares and in turn leads to an increase in share prices. They serve as a key indicator of its financial health and growth. This is why investors should monitor the earnings performance of the companies that they want to invest in. There are several resources to access this information about company earnings. These resources include company reports and filings. Companies that are listed on the stock market are required by law to disclose their financial performance through regular reports and filings. Investors can access these documents, including annual reports, financial statements, and other regulatory filings, through the company's website. There are also several financial news websites that provide comprehensive coverage of companies that are listed on the stock market. Websites like MoneyWeb, Fin24, and Business Day, these are all South African websites. They offer news, analysis, and other information regarding company earnings, along with insights from industry experts and analysts. You can also find information about the earnings of companies from some brokerage platforms. Some brokerages provide access to financial data and analysis tools. These platforms often include features like company profiles, company earnings reports, analyst recommendations, and stock screeners to help investors make informed decisions. By using these resources, this is how you as an investor can stay informed about the earnings of the companies that you invest in and make well-informed decisions based on analyzing the financial information available. Now, let's address the elephant in the room. Investing in the stock market comes with risks. Prices of shares can go up as well as down, and there is no guarantee that you will make money. But there are ways to reduce the risk of losing your money. One of those ways is doing your research before investing. Only invest in companies that are financially healthy and have the potential to grow their earnings in the future. Another way to reduce the risk of losing your money is to diversify your investments. It is not wise to buy shares of only one company or shares from only one sector or industry. As an example, don't put all your money into Anglo-American shares, because if something bad happens to Anglo-American, you could lose most or all of your money. You also shouldn't invest in companies from the same sector. For example, don't invest in Anglo-American Platinum, Impala Platinum, and Sibanye Stillwater only, because these companies are all part of the precious metals and mining sector. And if something bad happens to that sector, you could lose most or all of your money. Instead, you should spread your investments across different companies and different sectors to reduce your risk. This means buying shares from the banking sector, healthcare providers sector, food producers sector, the retail sector, the insurance sector, etc. The easiest way to diversify your investments across many companies and many different sectors on the stock market is to buy ETFs. ETFs, or exchange traded funds, are investment funds that are sold on the stock market just like individual shares. In very simple terms, ETFs are like a fruit salad of shares. When you are eating a fruit salad, you are eating pieces of different fruits like apples, oranges, bananas, grapes, strawberries, pineapples, etc. In the same way, you can buy an ETF that has got shares of Vodacom, Capitec, Shoprite, Sanlam, Clicks, Anglo-American, Sasol, etc. in one basket. As I wrap up today's podcast episode, I hope you found the discussion about the Stock Market 101 helpful. In my next episode, we're going to take a closer look at ETFs, exchange traded funds, and we're going to explore their features, their benefits, and how you can add them to your investment strategy. If you have any questions or topics that you would like me to cover in future podcast episodes, please don't hesitate to reach out. You can send your questions via WhatsApp to 072 586 2827. Please mention that it's for my podcast. Until next time, stay tuned and stay invested wisely.